Hello there, my name is Ross McAllister, and today I'm going to be discussing about what I think you, the client, should do with this £100,000 that you inherited. I'm going to be recommending a range of investments that I feel would be the most suitable to split the £100,000 across. I'm also going to be explaining the different levels in the market hypothesis, ranging from weak to semi-strong to strong. In terms of what I'm going to be discussing in this video presentation, there are many areas to cover, ranging from the three types of market hypothesis, as already mentioned, and what I'm going to recommend for you to do with the £100,000, once again, as already mentioned. I will also talk about the three low risk, low return opportunities, three medium risk, medium return opportunities, three high risk, high return opportunities that I feel could be useful in terms of splitting the money across. Once I've discussed all the positives that come with these low, medium, and high risk returns, I'm going to be talking about, I will then recommend one low risk, low return, one medium risk, medium return, and one high risk, high return opportunity that are the best options to split the £100,000 across. First off, in this video presentation, I'm going to be discussing the different types of efficient market hypothesis and why I feel they could affect how the money will be spent. In simple terms, efficient market hypothesis suggests that financial markets are so efficient that all available information is instantly reflected in asset prices, which makes it very difficult to consistently beat the market. In terms of how it could affect the spending of the money for you as a client, this theory has significant implications for investors, suggesting that active investment strategies like trying to pick stock that will outperform the market are unlikely to succeed consistently, and that passive investment strategies like investing in index funds may be more effective and efficient. While the efficient market hypothesis is a widely accepted theory, it does have its flaws, with some people arguing that markets are not always efficient and that irrational behavior can lead to price bubbles and crashes. There are three types of efficient market hypothesis: weak, semi-strong, and strong. Weak form. The weak form of efficient market hypothesis suggests that current asset prices fully reflect all past market data, including prices and trading volumes, which makes it impossible to predict future price movements based on historical information. In simple terms, this means that today's stock prices reflect all the data of past prices, and that no form of technical analysis can be effectively utilized to aid investors in making trading decisions. Semi-strong form. The semi-strong form of efficient market hypothesis suggests that all publicly available information is already reflected in market prices, meaning that neither technical nor fundamental analysis can consistently generate abnormal returns. The semi-strong efficiency theory follows the belief that because all information that is public is used in the calculation of a stock's current price, investors cannot utilize either technical or fundamental analysis to gain higher returns in the market. Strong form. The strong form of the efficient market hypothesis is when all information, both the information available to the public and the information that's not publicly known, is completely accounted for in the current stock prices, and there's no type of information that can give an investor an advantage on the market. In simple terms, these prices reflecting all available market information is the reason why investors cannot have an edge over each other by analysing the stocks and adapting different market timing strategies. There are many ways that the £100,000 could be spread out. However, I feel that the best way to spread the money out for you is to spread the £30,000 across the low risk, low return, which would mean that any investment with a smaller chance of losing money would offer lower potential gains, low return. I would then recommend £50,000 to be spread across medium risk, medium return, which would follow an approach to aim to strike the perfect balance between returns and time. And then the £20,000, the final £20,000, I would recommend by default to spread that across to the high risk, high return section. Even though the high risk, high return option offers the most potential for larger gains, or in other words, higher return, it's not always guaranteed due to the higher risk that comes with it, which is why I'd recommend the lowest amount to be spread across this one compared to the low risk, low return, or the medium risk, medium return options. In terms of low risk, low return opportunities, I feel great first option would be high yield savings accounts. High yield savings accounts offer lower risk due to the fact that they are FDIC insured up to $250,000 in the USA. They are super liquid, no market exposure, and your money is always accessible, and it's best for emergency funds and short-term saving goals. Some examples of this can be seen with Capital One Bank, who have an account known as the 360 Performance Savings, which is designed to help you earn more on your savings. This account will offer a higher interest rate than traditional savings accounts, allowing you to potentially earn more on your money. Their current interest rate is 3.70. Ulster Bank also offer a high-yielding savings account called the Loyalty Saver with tiered interest rates based on your balance, and their current interest rate is 4.75. The second low-risk, low-return option is Certificate of Deposit, as it offers low risk, and it's also FDIC insured. It's best for money you need immediately and has guaranteed return if held to maturity. Longer terms often mean higher rates. So say someone's plan is to hold money in savings for a while, then a certificate of deposit can help you earn more money with a guaranteed rate for a fixed term. It's more or less designed as a safe and secure way to increase your rate of return. One of the benefits of a CD is that it grows your money regardless of what the market does. And Santander is a great example of this, as they offer a CD for both personal and business customers with various terms and interest rates available. So a 6 month CD would be 4.75 and a 10-month CD is 5. For a third option, for low risk, low return, treasury securities are great, as once again the risk is very low, just like the other two, and it's also backed by the US government and has a return of 4 to 5%. However, this varies based on interest rates and term. It is best for conservative investors and inflation protection. You can also buy directly from the government via treasurydirect.gov, often with tax advantages. It is good because it can generate income, protect your principal, and help diversify your portfolio. The tax benefits are a lot stronger as well compared to CDs. Barclays Bank offer treasury securities through various platforms, including their Smart Investor platform, where you can access UK gifts and other bonds, and through their Wealth Treasury deposit, which offers fixed rates of return on money market deposits. Moving on to 3 medium return opportunities. Index funds is the first one, as they are good to invest to because they offer medium risk, which isn't great but isn't terrible either, and it also depends on how the market is doing. They're best for long-term growth with diversification, and they offer low fees, broad market exposure, and you don't have to pick individual stocks. Some good examples are S&P 500 ETFs, total market ETFs, and global ETFs. The largest S&P 500 ETF is Vanguard S&P 500 ETF, with close to $600 billion in assets. In the last trailing year, the best performing S&P 500 ETF was SPUU at 9%. Second option is real estate investment trust, and that's when a company that owns and in most cases operates income producing real estate, REITs, own many types of commercial real estate, such as office or apartment buildings, studios, warehouses, hospitals, shopping centres, hotels, and commercial forests, etc. It is a medium risk based on property market exposure and is best for real estate exposure without owning property. It pays out 90% of income as dividends, and it can be bought like stocks. British Land Company PLC are a great example of this, as they are one of the largest property development and investment companies in the United Kingdom. The firm became a real estate investment trust back in January 2007 when REITs were introduced. Their revenue in September 2024 sat at 131.5 million, and they had a net income and net profit margin of 54.5 million at 41.44%. Robo-advisors are a great third option, as they offer adjustable risk level, meaning you can choose the risk level. However, most people choose medium risk. It is good for hands-off investors and services like Wealthfront, Betterment, or Nutmeg UK. While robo-advisors don't have the human touch of a personal wealth manager, they handle the same task in managing your money. The advantage of going this route would be the cost, due to the fact that these platforms have less overhead, which would mean they typically charge lower fees than if you were to work with the traditional financial firms. Nutmeg UK is a great example of this, because they are the largest investment management company based in London in the UK, and they have 200,000 clients. Wealthfront are another example that are based in California. In 2023, they saw themselves doubling revenue to nearly $200 million and recorded its first full year of profitability, along with landing themselves on Forbes FinTech 50 list for 2024. Now moving on to the 2 high-risk, high-return opportunities. The first one I'm going to go with is cryptocurrencies. Cryptocurrencies is very high risk due to price volatility and regulatory risk. Examples of crypto include Bitcoin, Ethereum, Solana, Avalanche, or speculative altcoins. Some benefits with crypto are lower fees, faster time. Crypto transactions can have lower fees and faster transfer times than some traditional bank transactions. For example, crypto can potentially avoid high fees associated with global wires and be accessible within minutes, which is a big difference in comparison to standard 24 to 48 hour bank wire. A risk with it though is that with unregulated crypto asset exchanges and trading platforms present significant risks to investors, because key investors protections may be missing, including secure handling of client funds, safekeeping of assets, protection of personal information, and measures against market manipulations or other harmful practices. As of Wednesday, the 9th of April 2025, Bitcoin saw a 3.1 increase in comparison to Tuesday, the 8th of April 2025. Angel investing is a very high risk as it is illiquid, and most people feel when trying to invest in this. With angel investors, they take a long-term view and understand that they can get return on their investment after a long period, and research shows that angel investors supported startups are more likely to have substantial growth and give a higher rate of return. Top benefits of angel investing include the fact that if you invest early in a startup, even if it's £5,000, that investment could turn into 6 or 7 figures if the startup takes off. You also get a front row seat to cutting edge ideas and disruptive businesses before the rest of the world knows about them. This is especially exciting in fast working sectors like AI, biotech, or climate tech, or fintech. Tax incentives is another benefit because in the UK you've got SEIS and EIS schemes offering up to 50% income tax relief and capital gains exempted. Networking and deal flow means you build relationships with other investors, founders, and VCs, leading to more exclusive investment opportunities as this area is part of a high growth ecosystem. People tend to share the best deals with the people they trust the most. However, as previously stated, 80 to 90% of startups fail, and angels lose money or break even across many deals. And you may need to wait 5 to 10 years to see some real returns. However, one home run can pay for all of your misses, which is why this would be a high risk investment opportunity. So what is beta? In finance, beta measures an investment's volatility or systematic risk relative to the market. So linking this back to the index fund section, typically the S&P 500 with a beta of 1 indicates the investment is moving in line with the market. Beta quantifies how much an investment's price tends to fluctuate in relation to the overall market. Beta of 1, the investment price moves in line with the market. Beta greater than 1, the investment is more volatile than the market, meaning its price swings more widely than the overall market. And beta less than 1, the investment is less volatile than the market, meaning its price swings less than the overall market. So in conclusion, in terms of what I feel you should choose for the low risk, medium risk, and high risk, in terms of low risk, I feel the best option will be Treasury Securities as it's backed by the government and has more tax advantages in comparison to the certificates of deposit. It is also a semi-strong category of efficient market hypothesis, which makes it more viable option compared to high yield savings accounts, which has a weak form, and certificates of deposit, which don't come with the tax advantages, liquidity, and lower risk due to government backing that the Treasury Securities has. In terms of medium risk, medium return opportunities, I feel like all three of them had viable reasons to invest into. However, real estate has weak form of market hypothesis. So index funds are easy to trade, are very flexible, and have low fees. However, can require a lot of legwork and expenses, could eat into profits. Whereas robo-advisors are good for personalized portfolios and offers strategies like tax loss harvesting and rebalancing, but also lack the human touch that index funds have. All in all, I would say the best option would be the index funds due to the fact that there is less risk because the people involved will be clear on the investment guidance they are given on the market conditions, unlike robo-advisors that sometimes are not aware of the conditions that affect the market. In terms of the high risk, high return opportunity, I feel the best option for you would be the angel investing, as it is more structured than cryptocurrencies. It's because it's a semi-strong form of efficient market hypothesis, unlike cryptocurrencies, which is weak form. Even though they are both very high risk, angel investing offers more of a secure way of gaining substantial amount of money back due to the fact that in crypto, the markets always change every day, the payments are not reversible, and payments do not come with legal protections, unlike angel investing, which comes with the need to understand regulations, tax implications, and potential risks. Crypto transactions are often public as well.